This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Corey Kupfer, founder at DealQuest, host of the DealQuest podcast, founder and managing principal at Kupfer and Associates, and author of Authentic Negotiating. Corey, thank you for having me on your show, and thank you for joining us today.
Oh, it's great to be with you.
Great. So where does this podcast find you?
So I'm actually at my place in Marina del Rey, California. I split time between the New York area and Southern California in terms of living, and I'm on the West Coast right now.
Great. And so tell us a little bit about your background. What did you do before this?
Yeah, so my main business has been a law firm for a long time. I've been doing this for 35 years. I came out and did the New York City big firm thing, doing leveraged buyouts and public securities work and private placements. And so I've been in the entrepreneurial sort of deal, fundraising, M&A, leveraged buyout world for a long time. And then I've had my own, I have a speaking, training, and consulting company. That's DealQuest. We do negotiating trainings and I have the podcast, and, we do deal consulting. And then, I've done my own stuff. I've had a couple of funds where we've done real estate investment with some of our own money and other folks. So, I've in and around this world a lot.
Well, that's great. Well, a lot's happening in the startup world these days. What do you see as the driving trend that is top of mind for you these days?
Well, certainly access to capital right now is huge. I can honestly, I say this to folks, and this is generally true, but it's so true now that there's not a single good deal that can't get funded. There's just so much money at all levels. And I say good deal, right? Not every deal, but not a single good deal that can get funded. And then it's interesting. There's like tech and things like that, whereas there's typically a lot of innovation and startups going on, obviously continue. But then there are other spaces. I do some stuff in financial services, and certainly in fintech, there's been a lot of development. But then also just straight, like in the investment advisor world, we work with a lot of teams that leave banks, wirehouses, trust companies, and form independent firms. And there's a lot of startups in that area. And what's different from what was 10 years ago, there was no money in that space. And now there's a lot of money in that space funding these startups because they have books of business, right? They're leaving Merrill Lynch or Morgan Stanley, UBS, Goldman Sachs, with what could be $1 billion under management. And, so there's a cash flow stream there. So there's funding for these startups and for acquisitions in that space now.
So it seems like there's the great resignation continues and people are leaving the big firms to start their own. What do you see out there in that direction?
Yeah, listen, that term big resignation these days is, has come from the trigger of people reevaluating under the pandemic, or maybe, having different challenges or opportunities. But listen, in certain industries, I've been an advocate of entrepreneurship my entire, career. There's a reason why I stopped, 6 years out of school, stopped working at big firms and started my own. I think when you have disruptions like we've had now, with the pandemic, it has people reevaluate, and they want to have more control over their lives. They want to have, more freedom. They want to build something, in their vision. I always talk about the fact that I think that there are born entrepreneurs, and there's no judgment on this, by the way, right? There are people who, really should be a key executive or play some other role in a big company, right? They're just made for that, just knowing yourself. But there are folks that will always work for, someone else probably. And then there are born entrepreneurs who can't help but start businesses. But then there's a bunch of people that are in the middle, that are situational entrepreneurs, right? And, when things, I remember, the trend when big companies stopped, providing guaranteed employment and huge benefits and all these other things that supposedly made the big companies great and did for a while, then, you had a trend of people saying, well, okay, if I'm in this middle group, why should I stay here? Everything that I thought, they've taken away all this stuff. I might as well, do something more interesting. And I think you have another time now with the pandemic and everything where people are evaluating whether it's companies that are requiring them to come back to the office and they've started to like being able to work remotely, or they become digital nomads or, whatever. Circumstances are changing where the cost benefit analysis of they taking the risk of startup versus what seems to be a more secure path. I think more people are making that evaluation that, hey, I think it's a time to try something different and build something in my vision and my image and the way I want it to be.
So we're at the beginning of a brand new startup cycle here coming out of the pandemic. We have a whole new set of careabouts in the marketplace. We have a workforce that's wanting to do something new and different and better. And so we've seen this movie before, kicking off, I guess, after the dot-com bust and then in many other times in the past. What's the most important lesson you've learned when we kick off a whole new cycle like this for the startup and for the early stage investor?
Yeah, so I think, listen, from the startup point of view, obviously, when you have more folks that are coming into the startup world, there's more risk. Obviously, listen, this, your listeners know this for sure, that from the investor side, they're always looking for, established management teams, right? People who have success, before that's the highest predictor of success in a startup, more than, and more than the idea, whatever. So, when you have some of these new folks, there's a learning curve. So this is where you get some of the stats about companies that don't make it. But at the same time, you get new blood, you get new ideas, right? You get people that are coming from a different place. And I think, in these cycles, some of the best companies, are definitely started. From an investor side, we've seen a lot of pressure to deploy capital because they have a lot of it, and so when you have new people coming in to the space and new ideas, that's great, right? Because, there's more opportunity to vet. I think, I spoke to a couple of people recently who, were in that classic position where they were successful executives and the pandemic changed things for them. One was laid off, one just reevaluated the circumstances. And, they're more of these situational entrepreneurs, but at the same time, they have connections, right? They can build a management team. They actually have some of their own money, right? To be able to kick things off, or access to friends and family money to get to the point where they'll be investable. So I think when you have, some of these corporate folks that come out, obviously they're starting in a different place. There's big opportunities. A couple of the ones we spoke to, I think they have great concepts, and I think they have the resources and industry knowledge to pull it off, and they're going to be fundable.
Right. And what's your advice for startups that are kicking off in this time frame? What do you tell them to do before they go out to raise funding?
Yeah. So, listen, the first thing is, and listen, we all know that it's not necessarily going to be locked in stone and whatever, but, you want to be clear on what your business model is, what you're looking to do. Yes, you can pivot, all that kind of good stuff. But also, you want to get some sort of, people who've never done this before, they don't understand that, no, not everybody's getting funded, because they happen to be in tech and, and they're getting eyeballs, right? Create some sort of sustainable either revenue or, if you are somebody who's building a platform, at least, show that you're getting traction. And you got to be able to do that to some degree organically, right? To show that there's some traction there. And then, the big thing for me from the point of view of, because a lot of times I'm representing the companies, is, you really want to do one of the biggest mistakes they make, right, is not to really estimate what they're going to need for growth, right? And that's where, when you hear horror stories, you hear, that's what happens, right? They underestimate their need for capital, and then they get in a position where, they're stuck. So I always say, hey, listen, don't just look at what you need for this round. Let's really project out what you're gonna think you need for the entire runway to get to where you want to be, whether that's exit or critical mass and continued operations, and try to work backwards, and then the time you go out to the market, because if you're going out too early and giving away too much equity, you can get on this pattern where you can run into trouble. And also, listen, frankly, I love funded companies. Funded companies are the ones that are going to do, have the highest growth, often have the biggest innovation, whatever. But we all know that could be a trap. And, and if you get, too much money too early, it creates a lack of creativity sometimes and discipline up front to try to figure things out in a way where you got to be scrappier when you don't have money. So I think timing to market in doing it at the appropriate time, I think is the biggest thing that I work with folks on, because I think it's the place where there's biggest opportunity, to do it right, and also the biggest downside if you do it wrong.
What's the biggest misconception startups have about timing? What do you coach them against mostly?
Yeah, I mean, so what I coach them against, frankly, often is looking to raise too much money too early, right? And that's from 2 points of view. One, there's a certain segment of them that's going to waste a lot of time trying to raise money, and they're not ready for it, right? So now you could have put that energy and time into building the business, right? To become more fundable, but you're out running around trying to get capital when you're really not at a stage where you're investable yet. Or on the flip side, maybe you are investable, but you think that but your plans are super ambitious, and you're looking to raise more capital than you really need at this stage, which means that you're going to give away more equity at a lower valuation. And why not stage it in a way that's more appropriate? So I think those are the two things that I see. A lot of wasted time and energy on companies that are not yet fundable, with which they could spend into becoming fundable, and then just the anxiousness of raising too much capital too early.
On the other side of that table, what is your coaching to investors who are investing at this stage in this cycle?
Yeah, so I mean, it's interesting because it depends on who we're talking about, right? I mean, obviously, if we're talking about angels, and I represent a number of folks individual investor angels. We don't represent like a lot of funds or VC firms or that side. We're more on the company side or the individual, investor or small, or angel side. And, and for those folks, a lot of them, especially the folks who have made a lot of money doing something else and just either, are bored or want to deploy it or whatever, their risk sometimes is that they just invest on passion, right? Until they learn the lesson, after a couple of, so, how do they vet deals? How do they do due diligence? I actually think it's a great thing to invest in things that you love. I mean, I encourage that, but it can't be the only criteria, right? So that's number one. And then in those early stages, it's also, they tend to maybe initially invest in people they know, and that could be a great thing, or it could be a not so great thing because, they're known, they're vetted. You can argue that's good due diligence. Sometimes it is, but sometimes they don't have a clear view and doing a clear evaluation because it's a relationship. But I think that develops over time. What I find is, sometimes it takes, making a bad investment or getting burned, once or twice, and then people get smarter, with their money, because none of these folks like to lose money. And then also, the key is to, in my mind, either to one of two things: either to invest in what you know, right? Because that next hot thing is not necessarily, or if you're going to invest, in things you know less of, then invest with somebody, follow somebody who you trust, right? So, one of the great things about angel networks, right, is that you can, there may be somebody who is a successful investor that you admire who's involved, and you can piggyback, right? If they're leading the deal, you're like, okay, maybe I don't know a huge amount about this, but I've done enough due diligence on the lead investors that, I'll throw some money into this deal and get the piggyback and learn and see how they're evaluating a deal. That's a great way to do it, to get your foot in the door.
Great. So what online information source do you find most helpful in your work?
In terms of, it's interesting for us because, we certainly send people to some of the, some of the online angel networks, which, since you and I have met, I've added you to the list. And that's some of the biggest thing. And then the other thing that's obviously come up in terms of online stuff, although we don't personally do a lot of it, but I have somebody that I refer people to, is crowdfunding. It's interesting what's happened with that, and the people who know that space have have leveraged that at times. There are pitfalls to that as well. But I've seen actually some people do some good stuff with early crowdfunding online.
Well, great. Well, you run a successful podcast. What do you attribute your show's success to?
Well, so one, I would say that I don't start anything without studying a business model. So when I started my podcast 3.5 years ago, I spent like a year, honestly, figuring out all right, what is this whole podcast thing? Who's successful? I was fortunate enough to know some folks that had successful podcasts. And then also, what is my definition of success, right? I have a deals podcast. It's very niche. It's very specific. It's for companies that want to do deals and not just investment deals and sort of capital deals like you talk about, M&A and joint ventures and strategic alliances and licensing deals, you name it. And the whole purpose of it is that, is to have folks who are looking at, who have spent a lot of time trying to grow organically, see that there's this other way to help them grow as well through deal-driven growth. So I studied niche podcasts. I studied the model. I knew I'd never get millions and millions of downloads, although we've gotten many more than I thought we would. And I said, okay, what's the model? So one, consistency. Two, getting out ahead, getting great guests. And I put a marketing team together and an admin team that helps me do all that, so I can show up and do this right on the other side, and just interview people. And then, we promote it out a lot. And we also have kept to, I think, it's easy to become a general entrepreneurial podcast, and then you're in the mix with a lot of them out there, right? We've kept to our niche. We've done that really, really well. We always make sure there's a deal angle for any of our guests. They'll talk about some other stuff as well, but people know what they're getting, with the DealQuest podcast, right? They're coming to hear about deals. So I think that between that, understanding the model up front, putting a great team in place that promote it well, and keeping focused on what we do, on our value proposition about being about deals is what's made us successful.
Great. And so any tips for the other podcasters who are listening? What do you coach them to do?
Yeah, I mean, so one, do those things, right? Figure out, and then two, I think one of the biggest underutilized things, because the typical model is, you're supposed to get all these downloads, maybe get somebody to sponsor or advertise, and you're gonna make money that way. There's very few podcasts that do that, right? But what's really underestimated is what I call is the guest strategy. Okay, I mean, I had you on my podcast, just to use an example. Now you're having me on your podcast. We travel in similar circles. We didn't know each other before, right? I mean, this is the start of a relationship for us. And this is what I do with my guests. It gets me access to folks that I would not otherwise necessarily get access to. We're not going to go pitch them business or anything, but we're going to build relationships, right, with folks that are interested. I mean, they wouldn't be guests on my podcast if they weren't interested in deals. Whatever your podcast, your listeners' podcast is about, you're going to get people on who are in that field and interested in. Well, don't just have them on as a podcast. Have a way you get to know them. I mean, I do a pre-call, right? We get to know folks, and then keep them on your radar, do follow-up, look for opportunities for them. I mean, it's just a great way to build your network. And in terms of actual dollars, that's been the biggest, hundreds of thousands of dollars in benefit have come from the guests that I've had on the podcast, much more so than, suddenly a listener calling in and wanting to do a deal for them, although we've had some of that as well.
Great. Well, that's great advice. In the last few minutes that we have here, what else should we cover that we haven't?
Well, listen, I think learning, for me, like I said, I studied the podcast model. It's the same thing. If you want to, become an investor, don't just go out there and throw money at something, right? Study the model, figure out who the successful people on it, right? Are. There's so many reasons out there now, online and otherwise, or whatever, to do it. So whether it's a company that's looking to raise capital, or you're an investor, you're starting a podcast. I did the same thing when I wrote my book, right? Most people don't realize that most books sell under 300 copies, right? So they run out and write a book. No, I had a model around my book. So my biggest thing when I have people do anything, and I do it with folks with deals, I have a 10-step process with my clients where, we go from why to, before we get even to why are you even doing the deal, right? So my biggest tip on anything you're going to do is spend some time, figure out the model, study it, figure out where you fit in it. And then when you're in, you're in. Like, I'm a zero or hundreds of podcast guy. I'm not going to be that pod fade guy who has 10 podcast episodes, right? So study the model and then go all in.
Well, it's great. Appreciate you sharing that with us today. How best for listeners to get back in touch with you?
Yeah, thanks, Hall. So the best thing is, so I have a website, CoreyKupfer.com. That's CoreyKupfer.com. And that is where you can find out about my book and the DealQuest podcast and my workshops. And it'll also link you back to my law firm site, which happens to be kupferlaw.com, if you want to get there as well. So you can find out anything about me on CoreyKupfer.com.
Great. Well, appreciate you sharing that and giving us those contact details. We'll put those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Well, thanks so much for having me on the show. I really appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.